Hello everyone, welcome to video 3 of the Aerial Effects Mastering Your Psychology course. And in this video, we will be talking about psychology in entering trades. So we've all been there before. We're waiting to press the buy or sell button, but we haven't yet because we're nervous, or we're fearful, or we're scared, or maybe we don't know what's going to happen, or we're wondering if this is the right trade to take. So this emotional roller coaster in this hectic environment that we put ourselves through when entering trades negatively impacts the way in which we go about our trading. So I'm going to be showing some really prominent and common examples that probably many of you may face every single day when entering into a trade on your live account. So some of these things you may not even realize that you may be doing. So I hope to shed light on some of these things to clear up any confusion and to help you become better equipped to managing your trades and entering into them every day. So let's first start off by talking about confirmation bias. I'm going to go through each of these bullet points and help you understand what each of these mean, and then we're going to go over the example here to the right to sort of provide that example that you may actually be a victim of so that we can clear up how to properly eliminate that from our trading. So confirmation bias, what is it? Confirmation bias is essentially trying to come up with excuses or reasons behind why we're trying to long or short a position. So based upon our predetermined bias, in this example, it is a predetermined short bias. So let's say you're trying to short the market. Well, you may be thinking of every possible reason why you need to short it and not taking into consideration all of the information the market is actually telling you. Because the market is not going to lie to you. It's the same for every single trader. So it's going to provide you with all the correct information and the proper information that you need to take a trade. But if you're so focused on taking a short position and not looking at all of the facts and trying to confirm your own bias and trying to create excuses for your own trade, you may be severely impacting your trading. And this kind of ties into tunnel vision here. Tunnel vision is essentially, you're going through a tunnel, you're driving through it in your car, and you can't see anything on either side of you, only what's in front of you. And this applies to trading in its entirety. Most traders will focus only on one aspect of their trading. Maybe they're looking to short, so they only look at reasons to short the market, no matter what price has done or what it's actually continuing to do after maybe you've even got into the trade. You're still looking for shorting opportunities, but maybe you don't understand that price is actually going long. So that tunnel vision is severely impacting their decision making. And it's especially important because the human nature doesn't want, or it says we don't want to be wrong. We do not like to be wrong because it makes us uncomfortable. It makes us sad. It makes us angry. So in order to satisfy that nature that we have, we automatically try to come up with reasons why we're correct. We don't take into consideration the other side of the coin or understanding when we're wrong, accepting when we're wrong, and then moving on and learning from it. So we always have to think about reasons why we're correct and eliminate any possibility of us being wrong, which just adds to the problem and escalates more and more trades that you take that can severely damage your trading account. So selective interpretation and misusing information kind of ties in hand here. There's a saying, selective hearing, right? Maybe not a saying, but just a phrase. There's selective hearing. When people you're in a conversation with and someone's not really paying attention, but he's kind of paying attention a little bit, and he only chirps up with things that he wants to hear. Imagine like you're speaking to like your dog, right? And maybe your dog knows the word treat or knows the word walk or knows the word food or something like that. Well, you can be talking in a conversation, and then right when the dog hears that word come up in conversation with someone else, that dog immediately perks up because that dog has selective hearing for that particular conversation. Same thing goes with trading, selective interpretation. You're interpreting the market a specific way so that way that fits your own bias. So you're selectively interpreting the market through ways in which you can be correct and not lose the trade, but not having that holistic understanding of what's actually going on. You're not interpreting the market correctly. You're misusing that information to selectively interpret the market based upon what your bias is, trying to confirm your own bias, not having the understanding of what's actually happening. Chasing invalid setups. So this is part of this example that I will be going over. and not letting go of the trade. This is going to also be a part of this example. So let's just say that we have a predetermined bias short. Okay, so lower time frame, we're looking at lower lows and lower highs. Not having any idea of what's going on higher time frame, you're looking for a pullback to short the market because that is your bias. That is what you want to see, but maybe not what the market is actually doing. So in this case, maybe we come into an unrecognized higher time frame demand. Higher time frame to the left, maybe we're extremely bullish, and this lower low and lower high sequence is just the higher time frame retracement. So we actually come into a higher time frame demand that you did not recognize, and then we start to pull back. Well, this pullback is actually the reaction from the higher time frame demand. So we pull back, as confirmation bias traders will say, pulling back into the area in which price is going to go short from. Well, how do we know that? There's no such thing as 100% in this market. So let's take the information that the market is giving us. So with the confirmation bias retail mindset, they're like, okay, well, I'm going to be selling the market upon this break and retest of this supply level. Okay, so really just this huge buy to sell, or this start of the pullback before the sell-off to make a lower low, we're going to pull back into our level of supply. So we start shorting the market, and oh, look, it breaks this little tiny counter trend structure, and in their eyes, it's confirming the trade for them. They pull back again, maybe break and retest and start to short off again, and then price comes up and hits their stop loss, and then hits their stop loss both ways when they sold it here and they sold it in here. But they're looking at this like, okay, well, we come up a little bit higher, we're starting to push down now. Well, maybe I just didn't get in at the right spot. And also, FOMO sets in when you have another area of supply here and it just misses it and then price starts to fall. Then you're like, okay, I can't miss out on this trade, and I have to revenge trade my loss back. If you remember from episode 2 of this course, we talk about revenge trading. We have to revenge trade this loss back by getting back into the market, not having the understanding of the actual information the market is presenting you with. We actually came into a higher time frame level of demand. We pushed up, had the reaction, pushed back down, failed to generate a lower low in the market, but and actually create a higher high. So now we are not only higher time frame bullish again, we are lower time frame bullish, but you still have that tunnel vision and trying to find reasons to short the market. Price comes back up into another level of supply, and you're like, oh, finally, it comes up into the level, boom, short the market again. But why did price stop here at this exact spot before going long again? Well, the reason for that is because when traders were trading the break and retest of this level of market structure, we ended up stopping and breaking back above where they started to retest. So we retested their retest. Happens a lot, right? Because you have to make the retail traders lose, and then the institutional traders can get in if you're smart. But we already reacted off demand, so we knew that we're going long. We just have to play off the lower time frame structure now. Price comes back up, hits their stop loss as they try when they sold price from their second level of supply. Price comes up again, retest, and continues. They sell it here, busts right through their last level, and makes a higher high. Now what these retail traders are thinking is, oh, okay, well, you know what? I lost those trades. I still don't want to be wrong. I still want to look for shorting opportunities because I still have that tunnel vision. I still need to confirm my overall bias. I can't be wrong. I can't switch biases because that would say that I'm wrong. Let me try to sell at some random level over to the left. And if I get some sort of reaction, well, maybe then we'll go short. So that's what they try to do. They continue to look for reasons to sell even when price is now bullish. So we have not only reacted from a higher time frame level of demand, we had the reaction, failure to make a higher or lower low, we generate a higher high, and the counter trend continues. Not only did we make a higher high on the lower time frame, but we now made a higher high on the higher time frame as well. But retail is continuing to short from their overall bias that they think they can't be wrong in. So price starts to maybe go in their direction a little bit and then blasts off to the upside, continuing with the overall direction, and then retail loses yet again. All right, this comes into chasing invalid setups. This is not a valid setup. This is no man's land or an invalid sell region, but they still sell it anyways because they're trying to create that excuse for their own bias short. Not letting go of the trade. People are maybe holding the position short here, maybe not even having a stop loss. So many people don't have stop losses, and it's disgusting. You guys need to have stop losses in your trading. If you don't, you're just setting yourself up for ultimate failure. You better take your money out of your account and then go spend it on something else because honestly, you're just going to lose it. because what the psychology says about these traders is that when they don't use a stop loss and price is going against them, they continue to hold and continue to hold, thinking that price is eventually going to turn around and go into profit. Especially when price is coming up and retracing like this, they think, okay, let me just hold to break even. Let me just hold for a little bit of profit. When in all reality, we're making higher highs and higher lows, so we should be expecting a higher high after that. Then they continue to hold with every little pullback because they're holding on to hope, thinking that price is actually going to go in their right direction. When in all reality, they're misusing the information and not understanding what is actually going on and what the market is telling them. So they're not letting go of the trade there. So how can we, as institutional traders, eliminate this part of psychology from our mind? How can we beat this psychology from terrorizing our mind and creating a negative experience for us trading? Well, what I say is, first of all, do top-down analysis. Understand higher time frame and lower time frame. In addition, if you're looking to short the market, find all of your confluences for shorts. At the same time, look at the other side of the coin and say, okay, well, what if I was looking for longs? What would I be looking for? And write down all the confluences for a particular long setup, right? If you have more confluences for shorts, then you may place the trade if you feel so inclined. If you have more confluences for longs, then maybe you need to rethink the shorting bias that you currently have. That is how we can take a step back from the market and not let the market control us. Hindsight bias. Now, before I get into what the hindsight bias really is, I want to, go over this example really quick. This was an example taken within VIP community over the past few weeks, with actually few months within AUD NZD. We had a trade here, we had a trade here, here, and here. All of these trades can be tied back to that group that we sent it out in VIP. All right, so going over this example, even though these were live trades, I'm going to be going over them like they were hindsight because this is a really great example of what hindsight bias actually is. So hindsight bias is you going back and look at something that already took place or already happened to say, oh, that made sense. I should have taken that trade. And then you would have said, okay, well, all the confluences were there for the trade and that it actually worked out for me, meaning it actually worked out in the end, even though I didn't take it live. So you're overestimating your own abilities to trade, thinking that, oh, well, if I had seen that, well, I would have taken that trade and I'm a really good trader because of it. But go do some back testing and you'll see that you're probably right the majority of the time, that you can back test quite easily because you're not driven by the psychology of the market real time. You're going back and all these 4-hour candles are mere seconds as it's going along. So let's just say you may get a real reaction higher time frame, right? You're in profit and price comes all the way back down and all the way back down, right? And so you're very scared real time and you take out your trade at break even, or you maybe close it in a loss. And then price goes to the upside again and you could have won the trade. Well, in hindsight, you would have noticed that this was a valid region of price. And then your 4-hour candlesticks, even though these are days in real time, could be mere seconds on a back test. And you may think, oh, we got the reaction, we came back down, now we're in profit again. But in all reality, what's happening is you're seeing this with no money at stake, taking this as, oh, I could have entered this trade and held this trade. But if this actually occurred real time, the emotional side could have come down and said, oh, I don't want to lose this trade. Oh, I don't want to lose all the money. Let me get out down here. Let me get out over here because price is falling against my trade when I was originally up. This is the psychology that hindsight can have. It's easier said than done. Hindsight is essentially looking back in prior price or in the past for trading and seeing these examples of, oh, I can see why price reacted from this region. But the question becomes, could you have done it real time, having no knowledge of the fact that it actually came into that level and had the reaction? Would you have still placed this trade regardless? In hindsight, it's super easy. You'd be like, yeah, I would have placed that trade. We swept liquidity, sell to buy, higher high. This is our level of demand. Easy. But did you do it real time? That's the question. So you overestimate your abilities because you think that, oh, I'm back testing or in hindsight, oh, it played out, then real time it should play out for me because I'm just a good trader. What we need to do is take back testing. Obviously, it's very important, but at the same time, realize that you need to be able to manage your psychology before you can manage real live trades. Even though you may do a really good job back testing, your live trades may be the complete opposite. So don't think of all the hindsight trades you could have taken as, oh, I'm a really, really good trader. I should have taken these trades. You need to treat every trade as its own. Build the confluences, and if you have the confluences, be confident in the setup and treat each trade as its own in terms of its concept. It's not going to look the same every single time. It's going to look different. But if you understand the overall concept as to what's going on, then you'll be better equipped to enter into the trade. So for instance, liquidity runs look completely different every time. Nothing is going to look the same, but the concept of a liquidity run is always going to be there. But it's just us being able to interpret where that actually is, so we can better equip ourselves to enter into trades based upon the information and not based upon what we think is going to happen or what we thought or what we saw in the past, because nothing is ever the same. So we need to kind of almost not completely forget about hindsight, because it definitely is helpful in learning, but understanding that this doesn't mean that you're going to become this professional trader overnight because you've had 4 or 5 hindsight trades that you looked at. Try doing it real time, and then it'll make a little bit of a difference. You'll see it. Also, probabilities. Don't forget about probabilities. So it kind of ties into every trade as its own. As treating every trade as its own, you're giving yourself the highest probability to succeed, right? So probability says, especially high probabilities, you're giving yourself a high probability that this trade is actually going to work out in your favor. So when trading live, make sure you're building as much confluence, giving yourself that highest probability, and not basing your trade off of, oh, well, I had this, I looked at past price and it did this, so if I just do this time, I should have the same outcome. Well, hindsight bias can be very, very it could be very much detrimental to your trading, because when you think about it, let's just say we're looking at price in here. Okay, price has already come down to this level of demand. When you're looking at price in here, you're like, oh yeah, I can see how that would have reacted. So that way, when price comes back down, you're looking at entering into the nearest demand zone that you can find, and then looking to take a trade because, oh, if this worked out, then your next one worked out. Even though you didn't take this trade as its own confluences and as its own, and you didn't build probability around it. Even though this actually played out for this particular example, I think you get my point though. So we can't let hindsight be the reason in which we do other things in the market, like over leverage on a position or take a trade because I was right the first time in hindsight. Stuff like that. We have to treat the trade as its own, build confluences. Imagine taking a trade, and if you lost, you go to jail for a year, right? You would be very selective. You'd be very keen to understand how the market is actually moving, right? To treat it like that. Treat it like it's, do or die here. That's how you can eliminate all the bad trades and only take the good ones. Entering too late. So when entering trades, oftentimes many traders enter too late. There's many different examples. One with indicators. The only indicator I use really is higher time frame 50 EMA, because it gives me the overall direction, but it's not my only confluence when trading. I hardly ever have it as a confluence. I just look to see, what price is doing around those levels. Also, the VFI. VFI is the only indicator that I can see in terms of price divergence that shows up that's really helpful for higher time frame areas of interest. Because in a higher time frame area of interest, if there's divergence, then there was divergence on a lower time frame prior before, giving me the highest probability chance. It's hard to explain that, but what I'm trying to say is the problem with indicators is that they're lagging. That's why I don't use them. Those are the only two that I use that don't really come down to the actual entry itself. It's not the confluence that I have for my particular entry, but it guides my trading to say, okay, well, if I have this along with all my other confluences, then it just gives me a higher probability chance to succeed with that trade. But it's not my only confluence. Many people trade indicators specifically, like the MACD, maybe the RSI, maybe Bollinger Bands, maybe the ATR. I don't know what you guys use, but the problem with indicators is that they're lagging. right? Price has to do something before the indicator can sense that it has done something so that the indicator can catch up with what price is doing. Indicators are not going to tell you exactly real time what price is doing because price hasn't done it yet. It has to wait for price to do something, and then the indicator can update update the indicator and where it is, right? So by the time the indicator is telling you to short, maybe price has already gone long. It has already made its move. So we can't rely on indicators. We have to look at what price action is telling us. Price action is real time. Indicators are lagging. They give us very, very bad trade entries, which is why maybe some of you may get into a lot of drawdown on your trades, okay, by using indicators. You can't use indicators consistently forever. It's just not going to work. Also, waiting for too much confirmation. So for this particular example, maybe there is a supply block here. We're higher time frame bearish, right? So maybe this is a huge downtrend here, and now we're starting to lower time frame pull back into a higher time frame level of supply for an overall expansion to the downside again. So what price does is maybe we consolidate, create liquidity below this low here. We come down, sweep that liquidity, maybe tap into a demand zone, and then we rise up and we break structure. So this huge sponsor candle, sell to buy. And then what you're looking for is you're looking for another high potentially. So in all reality, the smart money entry would be in and around the mitigation of our supplies, or excuse me, of our sponsor candle. But you're looking for, as retail traders, and I'm not saying you, I'm saying you in general terms for retail traders, that retail traders are looking to buy upon the breakout of the high, because could this just be a low, a high, and then a lower low again, right? Even though we're bullish until we reach this supply level, many wait for the breakout. So they either could enter here, right at the top, because price is broken out, and they're like, oh, I got to trade it long. I have FOMO. They're not waiting for a pullback, but maybe they get the pullback and they're waiting for price to break the high again to get in here because they're not quite sure. So their entry may be there, but the smart money entry may be here. In addition, what if price came to this higher time frame level of supply and then started to retrace? So meaning in here, we sold to buy, we made the higher high, but we tapped up into it first. Would it be smart to take the trade long as a pullback? The answer is no, because we already hit the higher time frame objective. If we didn't hit the objective, like we didn't here, this price did not push up into here yet, now we have room to go to the upside, to where if we pull back, we know we have more room to go. So that gives us the trade. Many people are entering way too late. They're waiting for too much confirmation to tell them, okay, get in, get in, get in. Just like with indicators. They're waiting for the indicator to say something before getting in, but by that time, price has already made its move. Whether it be indicators or whether it be this example, price has already made its move, and now you're getting in at a premium, right? And then when price rolls over, you're losing. Also afraid to lose. You're so afraid to lose, and you have lack of confidence, not information, meaning you're afraid to lose and having lack of confidence, meaning like you don't want to lose the trade, so you're coming up with so much confirmation to try to support your bias that if you lose, you're going to be very angry, right? So you want as much confirmation as possible before entering, and you're not that confident in the trade, maybe because you don't understand the strategy, and maybe you want to just satisfy your own psychology and your own emotions by waiting for so much confirmation and everything, so that you aren't afraid to lose, and you have so much confirmation to enter into a trade, but you may be entering in too late because you're waiting too long. So it's not the lack of information, it's the lack of confidence. So when people lack confidence, the information is already here. We're already screaming longs from this level. The information says liquidity has been run into demand. We're creating higher highs, higher lows. We're pulling back. We've broken counter trend into this sponsor candle. We have more room to go to the upside. The information is telling us to buy. But we are lacking confidence to enter, so we say, okay, we'll wait for a bullish engulfing candle because price is selling off. We'll wait for some sort of maybe break of structure again, or some big engulfing candle to tell me, okay, we're finally going long. By that time, you're entering up into premium price. You're getting in too late. Price will then, come up maybe a little bit in your profit and then just roll over because it has now hit that objective in the higher time frame supply level. Okay. Also, FOMO. all that ties together. Afraid of missing out, right? Maybe you didn't get this entry here. Maybe you were sleeping, or maybe you just didn't see it in time. Well, then price is starting to push up, push up, push up, push up, push up. You're like, oh, I gotta get in, I gotta get in. I missed the entry. I gotta get in. So they get in not only too late, but they're so scared of missing out on the move to the upside into this level that they're getting in, and their risk to reward significantly decreases, and their chances of losing the trade significantly increases, right? Because if you're getting in up here because you're afraid of missing out, well, price is about to reverse on you and go short because it's hit the supply block. So the fear of missing out does tie into entering too late again. You should be entering a lot earlier based off of price action in here or in here, but your lack of confidence, afraidness to lose, waiting for too much confirmation, and maybe FOMO will tie into your reason for your entry up here. All right. So we need to be taking things from an objective standpoint and not from an emotional standpoint. What is the market actually telling you? Get into the market based upon what's telling you and not what you want to see or want to feel before getting into the trade. Chasing performance also ties into entering trades. So within the psychology of entering trades, living up to expectations is huge, right? So you want to perform a certain way. Maybe you want to hit a certain performance target or a return goal. So your entries may be the justification for those particular goals that you have or expectations that you have to live up to. Maybe you are pressured into making 10% return for a prop firm challenge. Maybe you are down a few percent but don't want to end the month in a loss, so you have to over leverage. So that chasing of performance affects the way in which you enter into trades, and it all ties together with revenge trading losses and over trading to try to compensate for the lack of return, or over leveraging to try to hit a specific return target. So it affects the way you enter your trades through expectations or other outside forces that are giving you expectations to live up to. Past performance is not indicative of future results. You've heard this and seen this probably so many different places across so many different financial platforms, but it is very much true. Just because that you have had maybe a winning streak, or you have won the prior trade or have great prior past performance, may not be so indicative of future results. Just because you won one trade doesn't mean you're going to win the next one. Even though you have a great strategy and maybe you have quote unquote mastered it in a sense, no, even though no one can really master anything, you're very good at something. That doesn't mean that the next trade you take is going to be a winner, because each trade needs to be taken at its individual level. So you could go on a 10 trade winning streak and then go on a subsequent 10 win or 10 loss losing streak, right? Past performance of something is not quite indicative of future results. It may give you an indication potentially of this person doing overall well, or your overall trades over the average over some time may do well, but that doesn't mean that you are guaranteed future results that are the same as your past performance, because everything in trading and everything in finance and investing is going to be different. Nothing is ever going to look or be the exact same. Chasing performance before I get into outside influences, chasing performance for past performance is not indicative of future results. Maybe because you're so used to making 10, 20% a month in your trading, right? Maybe you go on a 2 or 3 month winning streak. You think that should be the indication of future months being 10, 20%. So when you're trying to chase that performance because you may not have had the best of month, then you try to chase that performance because you think that past performance should be how you should be every single month, when in all reality, that's not the case. So you're chasing that performance and entering trades irrationally and not properly to try to catch past performance in the future, if that makes sense. You're chasing your performance that happened in the past, in the future, or in the present time, to try to get future results that are the same. Next, going through outside influences. Chasing performance through outside influences. You may have friends or family doing very well in trading. You may have mentors or a group of people who may be doing a little bit better than you, who maybe have more experience. So trying to chase their performance to try to get on their level, or to make as much money as you maybe your friends or family are because no one wants to be the last in line. No one wants to be doing not as well as the other beside them. Right? If you see someone doing quite well and you want to do that too. You don't want to be that person who can't do well. So letting other people influence that part of your psychology will negatively influence the trades that you take. So when you chase that performance of others or try to live up to the performance of others that others may have, you're letting irrational decision making overtake your trading. Your entries are going to be a lot worse. And then that leads into over trading and over leveraging. So you're over trading, trying to compensate for maybe the amount of losses that you had or the lack of trading that you had, or maybe trying to generate as much profit as you can by placing a lot of different trades because you want to be up to the standard of a peer or a mentor in regards to performance. Over leveraging as well. When you see other people doing well, maybe you have a trading partner, maybe you have a good friend who may have made a good amount of money that month. Maybe he over leveraged and made $5,000 on his $1,000 account. Well, you are jealous of that profit, so you try to do the same in hopes that you can be on his level as well. So then you over leverage and put yourself at risk, not having any understanding of risk management when it comes to trading. So this is how outside influences can negatively or severely negatively impact your trading performance going forward. Time and price is also very important in entering trades. So obviously many of you may know that Aerial FX, we trade smart money concepts. We are institutional traders. So we have to be trading at certain times of the day, knowing that these institutions manipulate price during certain session times. They usually do this during the Open of London session, the changeover between London and New York session, and the New York session open. So they have specific times of day where liquidity is oftentimes run. So the manipulation occurs during those specific sessions or those specific times of day. So when people are looking to enter, maybe during Asian session when the volume is extremely low, or maybe the swaps or commissions are extremely high, or the spreads are high, they don't really understand that they're entering at the wrong time of day because they're entering in the wrong session. You don't want to be trading Euro USD during Asian session. Euro, a European pair, a London session pair, or a currency, excuse me, paired with a US dollar and New York session currency is not something you should be trading during Asian session. So time and price is definitely very important because if you're trading Euro USD during Asian session, you're most likely going to get your stop loss attacked during the manipulation that occurs during London and New York session. Entering near market closure every single day and every single week. When the market closes, for me, it's at 5 p.m. Eastern Standard Time each day. The spreads significantly increase. So why would you want to place a trade during the market closure time? You're going to be given a very, very worse price than you originally wanted because the spread is so high. Also, near market or entering near the market close for the week, for me, it's Friday at 5 p.m. Eastern Time. You're entering when the market is closing. Oftentimes, what will happen is you will be given swap charges for holding over the weekend. You don't want to be incurring unnecessary swaps. In addition, Sunday, for me, when the market opens, is oftentimes a time when Friday liquidity is also attacked. So if you're entering prior to market closure for the week, your stop loss could easily be attacked when the market opens, sweeping liquidity before moving for the entire week. The effects of spreads and swaps, we kind of already talked about that. So Asian London and London New York traps, are you the victim of market manipulation? So if you're trading at the wrong times of day, maybe you find yourself getting stopped out at the beginning of London session and maybe the beginning of New York session between London and New York. So those times of day, I don't know if you've ever realized maybe your stop losses are hit around within like 1 or 2 hours of the same time every single day if you're trading. If that's the case, you need to understand when the market is really manipulated. There are certain times of the day that it is. So if you're seeing that you're getting stopped out, maybe, and I'm going to make this up, maybe your local time, maybe like 10 o'clock, and I'm just making this up, guys, maybe 10 o'clock, between 10 and 11 or 12 o'clock each and every day for you, you get stopped out. Maybe that's a sign that, okay, whatever that time is in your local time based upon the actual session times, maybe that's a time where the markets are being manipulated at its most. So you're being a victim to that because you're not entering during the right times of day, even though you may have the right setup. So not only do you have to have confluences for your setups, but the time in which you do so is also very important. So that can definitely affect entering your trades. So the exercise I would like for you guys to take part of is over your next month of trading, ask yourself the following questions prior to entering a trade. And you can write these down, take a screenshot of them, whatever you'd like to do, but keep them beside your trading desk or computer, laptop, phone, whatever you are using to place your trades or do analysis on, and ask yourself these questions every single time before you place a trade, which is when you will be entering the trade. What are my confluences? Does this trade meet my rules? What is the probability of this trade actually playing out? Is this a valid setup? Am I confident in this setup? Am I making an emotional decision? Am I entering too late? Am I following proper risk management? Am I entering at the right time of day/week? Am I treating this as an individual setup, or am I just trying to reach a profit goal? Repeating this process for every trade that you take for a month's time straight will positively, drastically change the way in which you enter your trades. You will build that habit because we know that habit or repetition creates habit. And in psychology, you are taught that if you do something, I think it's 21 or 22 times, it becomes a habit. So make the habit of doing this stuff. I ask myself these questions all the time before I'm entering into a trade. This is what professional traders are doing. They're very professional in the way that they're going about it. They don't look at a chart, become emotionally attached to it, and then try to take a trade. They ask themselves these questions. Because if you set yourself up before the trade even takes place, then there's no such thing as bad psychology when entering into a trade, which is why we had this whole video. So if you see yourself falling victim to any of this stuff that I've been talking about throughout the video, take a step back, maybe rewatch this video, get a good understanding of the problems that you face, maybe write them down, and then use these questions based upon this exercise to come up with solutions for those particular problems that you face. Also, reach out to me, and I can guide you through your specific example that you have, through the problem that you face in your personal life, into the right way we can provide solutions for you so that you don't have to go through that hectic emotional roller coaster of entering trades. So guys, I hope you enjoyed this video. Hope you took some value from it. As always, if you have any questions, please feel free to reach out. And I hope you enjoy and are prepared for the next video.